Hello class, this is chapter 7, accounting for cash. This is accounting 100. So cash includes currency and coins, checking accounts, checks received from customers, money orders, and bank cashiers checks. Because cash plays such a central role in operating a business, it must be carefully managed and controlled. So there's definitely a separation of responsibilities. Internal control, a set of policies and procedures designed to ensure proper accounting for transactions. Good internal control for cash transactions. All cash received should be deposited daily in a bank. All disbursements except for payments from petty cash should be made by check. So here's objective 1. Describe how to open and use a checking account. So USA Patriot Act, primary purpose of this act was to help detect and prevent terrorism. As a result, banks must have a customer identification program, CIP, that provides clear identification of every account holder of the bank. Each person authorized to sign checks must complete a sign a signature card. This card is used to verify the depositor's signature on any banking transactions. So here's what one looks like. This is also in your book or online textbook. Making deposits. A deposit ticket is a form showing a detailed listing of items being deposited. Currency, coins, and checks are listed separately. Each check can be identified by its ABA, American Bankers Association number. This is found in the upper right-hand corner of each check. Also appears in magnetic ink character recognition MICR code on the lower left side of the front of each check. The code is used to sort and route checks through the banking system in the U.S. Each check being deposited must be endorsed by the payee, the party to whom the check is payable. The endorsement consists of stamping or writing the payee's name and sometimes other information on the back of the check. Businesses commonly use a rubber stamp to endorse checks for deposit. So blank endorsement, the payee simply signs the back of the check. This makes the check payable to any bearer. Restrictive endorsement, the payee adds words such as for deposit only, paid to the order of specific bank, or pay to Daryl Beck to restrict payment to a specific party or purpose. Automated teller machines, ATMs, which you know what these are. Each depositor has a plastic card and a personal identification number. Most automated teller machines are on a system that allows non-customers to use their ATMs. It is important for the depositor to keep an accounting record of ATM withdrawals and deposits. Writing checks. A check is a document ordering a bank to pay cash from a depositor's account. There are 3 parties to every check: the drawer, the depositor who orders the bank to pay the cash; the drawee, the bank on which the check is drawn; payee, the person being paid by the cash. Business checks often have a check stub. 3 steps in preparing a check: complete the check stub or register, enter the date, payee name, and amount on the check, signing the check, which most of you already know how to do this. Bank statement, a statement of account issued by a bank to each depositor once a month. The statement shows the beginning balance and deposits and other amounts added during this period, checks and other amounts subtracted during the period, the balance at the end of the period. It's sent with the bank statement, cancel checks, image, sheets of check faces, or a listing of checks, any other forms representing items added or subtracted from the account. Objective 2, prepare a bank reconciliation and related journal entries. So bank statement shows a balance of $17.48.09, but the general ledger cash account balance is $2,393.23. So we'll reconcile that. So Here's a reconciliation example. It has to include a heading, name of the company, and the date of reconciliation. So the bank statement balance on November 21 is $1,748.09. Add any outstanding checks or deductions. So this is the format. Once all reconciling items are listed on the adjusted bank balance is computed. So book balance is on November 21 is $2,393.23. Add additions, subtractions, or deductions. Those are two areas you need to put, and then the adjusted book balance. Okay, so the adjusted bank balance must equal the adjusted book balance. So we say it is reconciled when the adjusted balance and book balances agree. So let's go through this here in a bit. Deposits in transit, deposits that have not reached the bank or been recorded by the bank before the statement is prepared. Outstanding checks, checks that have been issued but have not been presented to the bank for payment before the statement is prepared. Service charges, bank charges for services such as check printing and processing. Collections, collections of promissory notes or charge accounts made by the bank on behalf of the depositor. Not sufficient funds NSF checks because, checks deposited but not paid because the drawer did not have sufficient funds. Errors made by the bank or by the depositor in recording cash transactions. So 3 steps. First one, identify deposits in transit and any related errors. 2, identify outstanding checks and any related errors. Lastly, identify additional reconciling items. So then here's step 1 in more detail. Compare the bank statement with last month's deposits in transit. They should all be on the bank statement. Deposit listed in the accounting records. If not found on the bank statement, deposits is considered a deposit in transit. Individual deposit amounts in the accounting records. If they differ, the error needs to be corrected. So here's 2 a little bit more in depth. A deposit in the accounting records of $637.02 dated November 21 had not been received by the bank. So this is deposit in transit. So here's what we put that deposit in transit right here, $637.02 under add. Okay. 2, compare canceled checks with a bank statement and accounting at records. If they differ, the error needs to be corrected. Check mark the stub or accounting record to indicate the check has been cleared. Checks written but not cleared are outstanding checks. These are subtracted from the bank balance on the reconciliation. Example, check number 214 was written for $18.98 but was entered on the check stub and the books as $19.88, so an error of 90 cents. So then 90 cents is added to the book balance. Error on check, and this is exactly what you would put on there. Check number 219, 224, and 227 do not appear on the bank statement, so these are outstanding checks. So we'll put outstanding checks, we'll put them listed just like this, 219, 224, and number 227, 200, 225, and 67.78. So add that up right there, 292.78 for a total. 3, identify additional reconciling items. Compare any additions and deductions on the bank statement that are not deposits or checks with the accounting records. Items added to the account by the bank are credit memos. Items deducted from the account by the bank are debit memos. So here's an example. Maple used an ATM machine to make a withdrawal of $100 for personal use. However, he forgot to record this withdrawal on the book, so deduct $100 from the book balance. So unrecorded ATM withdrawal, $100. So the bank returned an NSF check of $200 written by one of Maple's clients. Deduct $200 from the book balance, so that goes as a deduction. NSF check recorded exactly like that for $200. Okay, the bank deducted $1.80 from Maple's account for a service charge, which was not on there, so deduct $180 from the book balance. Again, that goes right there. Those are the deductions. And then the book balance section of the reconciliation is total. So we have an adjusted bank balance of $2,092.33. And then the book balance is totaled right here as well. These are our $23.94, then we'll deduct $301.80, and we get $2,092.33. So these two are in balance, so we have reconciled the bank and the book balance. Okay. So journal entries are needed. That is true. We made adjustments on there, so we got to put them on the ledger. Okay. Only two kinds of items appearing on a bank reconciliation require journal entries: errors in the depositor's books, bank additions and deductions that do not already appear in the books. All items in the book balance section of the reconciliation require a journal entry. So just on the book balance side, error check for 90 cents, and then the ones that are highlighted in orange, those are the ones that we will make journal entries for. Keep in mind that what happens on the bank, that's not on what we're worried about. We're only worried about, as far as the entries, we're only worried about our side, our books, okay? So these are the ones that will require journal entries. So depositor, or here's the description: cash for 90 cents, accounts payable 90 cents, error in recording check. Here we had a draw for $100, and that's coming out of cash, so we got to put that in cash as well. Unrecorded ATM withdraw. So this is the accounts receivable for $200. So basically, we're putting it back into accounts receivable, and we're pulling cash out of there because the check bounced. So miscellaneous expense $1.80, cash $1.80, that came out of cash. Okay, so typically when this happens, I'm not too sure if we'll get to this in this book, but once they pay it again, then this will be $200. More than likely, they'll pay a service fee. Okay, so typically banks will charge you a service fee or a return check, so they'll charge us, so this will go up a little bit as well. Electronic banking, both deposits and payments can be made using electronic funds transfer, EFT, using a computer rather than paper checks. Businesses are making increasing using use of EFT. Employee wages can be paid using EFT. Bills from suppliers can be paid by EFT. Payments from customers frequently are in electronic form. Funds can be transferred electronically among multiple accounts at different banks. When EFT is used, accounting records must be correctly updated. Objective 3, establish and use a petty cash fund. So this is important. So a fund set up to pay for small petty items with cash. Checks for very small amounts are inconvenient and inefficient. To establish the fund, a check is written to the petty cash custodian for the amount to be set aside in the fund. The custodian cashes the check and places the money in a petty cash box. The custodian should be the only person authorized to make payments from the fund, so there's a separation of duties. Petty cash fund example: Maple wants to establish a $200 petty cash fund to be used to make small purchases. So cash is going to be withdrawn from $200, okay, and then we're going to credit, or we're going to debit it for $200 in petty cash. So we're moving it from cash over to petty cash account. So here's how we record it: petty cash, we created for a debit of $200, and we're crediting for $200, so we're moving it from here to there. Petty cash voucher, a receipt prepared for every payment from the petty cash fund. Voucher shows in the name of the payee, purpose of the payment, accounts to be charged for payment. Example: postage expense, signatures of the custodian and payee. A special multi-column record that supplements the regular accounting records, provides a record of each petty cash payment, broken down by account. Example: travel, entertainment expense, postage expense, so on and so forth. Used to prepare the replenishment journal entry. The petty cash fund should be replenished whenever the fund runs low and at the end of each accounting period. Once the fund is established by debiting petty cash and crediting cash, no further entries are made to petty cash. To replenish the fund, debits are made to appropriate expense accounts and cash is credited. Only if the amount of the fund itself is being changed would there be a debit or credit by petty cash. Because the petty cash payments recorded is not a journal, no posting is done from this record. A separate entry must be made in the journal to replenish the fund. Okay, we'll also go over this if you take accounting 200. We go through over petty cash and bank reconciliations as well. At the end of the month, the petty cash fund contains 8 vouchers and only $11.20 in cash. The fund needs to be replenished. To replenish the fund, a check is written for $188.80, which is the total of the 8 vouchers. A journal entry is made to recognize the expense shown on the vouchers, the outflow of cash via the check. So here's what it looks like. Automobile expense $40.80, postage expense $39.50, travel and entertainment expense $40.25, miscellaneous expense $38.25, and then a drawing of $30 by James, $30. So we're gonna pull that out of cash for $188.80, okay, which is the difference. Don't forget, we always want $200 in our petty cash. So the journal entry balances, so we're good to go on that. Replenishment of petty cash fund, so we'll put a little note right below it. So chapter 4, establish a change fund and use the cash short and over account. So this is a supply of currency and coins kept in the cash register or cash drawer. Okay, this is a change fund. Allows businesses to make change when customers pay in cash. At the end of the day, cash received during the day is deposited, but the change fund is held back for use on the following day. Shorty's Cleaners is opening for business on June 1. Shorty needs to establish a $200 change fund, so he takes it out of cash and puts it into change fund. So credit cash, debit change fund. So this is the journal entry. Change fund, debit 200, cash, credit $200. Established change fund is the note. Change fund example: at the close of its first day of business, Sporty's had $14.50 in the cash register, so cash in drawer $14.50 minus less change fund $200, so cash from sales is $12.50. Okay, let's see. So here's what we do: cash $12.50, service fees $12.50, cash received for services. So that would be the journal entry. At the end of the business day on June 19, Sporty's had $11.61 in the cash register, cash in hand $11.61 minus $200, cash from sales $9.61. So the register tape shows $963, so it looks like we are short. So we are short $2. So this will go in cash short and over. So here's cash of $961, cash short and over $2, and service fee of $963. So we just recorded that it was short. Okay. Now this one, Sporty's had $10.15 in cash register, so $10.15 minus $200 gives us $8.15. The tape showed $814 in sales. So there's the difference in that is $1. So we have an overage. So now we go cash. Again, $8.15 was collected. Cash short and over is $1, so it was over $1. So then service fees $8.14. So this records service fees and cash overage. So then it still balances. Our journal entry still balances. The cash short and over account is used to accumulate cash shortages and overages throughout the accounting period. At the end of the period, a debit balance in the account net shortage is treated as an expense. A credit balance in the account net overage is treated as a revenue. So if it's short, it's an expense. If it's over, it's a revenue. So here's something you can go through. This is a little thing you can read through. It's in your book as well. If you have any questions, please email me. Also, if you have any missing homework, please get that turned in as soon as possible. If you have any questions, have a good day other than that. I'll go on it. Yeah.